So let's resume this.
Terms. I'm talking about the chain link. And you had a $10,000 initial investment. That could have grown to as much as what, $2,340,000?
Right. The exact figure at the top of the market was $2,333,746.
$2,333,000.
$746. You should know, though, that I did not pick the exact top. I waited for confirmation, which came after the first significant correction. Then I issued a series of sell signals.
Another thing I remember from 2018, and I'm sure you do as well, is that a lot of Wall Street experts were saying Bitcoin is dead. This time, did we have anything similar, or is it different this time?
Oh, it was worse. I think it was worse. Like, the people who were calling for the death of crypto were just screaming from the rooftops. It was amazing. In fact, I had to switch off social media.
Typically, crypto doesn't make it to any of the major evening news programs like Fox, CNN, NBC, or anything like that, right? But when FTX collapsed, it was top of the news for days on end.
And everybody said, oh, it's the end of crypto. This is it.
So when they say it's the end of crypto, it really means to you the end of that particular bear market and the beginning of a new bull market.
You contrast what people are saying with what prices are doing, you notice a discrepancy.
Okay, that's just the setup. So what else do you look for?
Like we always say, I don't start looking for the bottom until it's time.
So at the end of the day, it's about time.
Markets can look pretty chaotic. When you just look at prices, oh, high volatility, we don't know where it's going, look at all these headlines. But if instead of doing that, you just tune out all the noise, stop reading the headlines, and just count time, you're going to notice that markets are actually super regular, crypto in particular, because so far the pattern of year-long bear markets, about 12 months, give or take a month. You start at the top, you count 12 months, and the low is going to be around that time. In spite of all the headlines, in spite of the world coming to an end, the bottom is always around a year from the top.
You just tune out all the garbage and just listen to the beat of the market.
And then you start noticing that markets are not that chaotic. It's actually pretty orderly when you look at the time element.
Since we're talking about time, right, and the rhythm of time, tell us about the time markers you see ahead in the market for Ethereum, for Bitcoin, for any other coin that you're tracking closely.
Okay, so this is a chart of Bitcoin in 2018. All right, the dashed line is when I made the call. This is December 12th, 2018. And the solid line is the actual bottom, right?
And the only people still holding Bitcoin are what they call hodlers, right?
We call them diamond hands now, Martin.
Oh.
They're the diamond hands. Yeah, the name changed.
So let's move ahead and see what happens after that. You give the second signal.
It's a few days before this pop. I remember this pop was epic because Bitcoin went up like 20% on a single day. And it was a huge move.
I see.
Almost triples your money in a few months.
Okay, so then let's move forward.
And so we move forward, and now we're in bull market territory. Now things are looking good. We had the rally post-COVID.
Mm-hmm.
After the COVID crash, after all this drama, Bitcoin is back above 10,000 in late July of 2020. Mm-hmm. And this is when we load up the truck, basically. At this point, we're just fully invested.
Perfect.
Yeah.
Wow.
And yeah, it just goes. And it just goes.
It just keeps going and going and going. It's better than the ever-ready battery. Okay. Oh, wait a minute. What? This is
the 2021, May 2021 correction. We also avoided this.
Okay.
The reason we avoided this is the same reason we wanted to sell in May 2021. Too many bulls. Everybody was just too optimistic. And my leading indicator for this, futures markets, they were insane. Pricing in moves that were just impossible.
Nice.
Trading at 50% premiums over spot in like 6 months.
50%?
Yeah, you couldn't use Ethereum. You couldn't use most blockchains. You couldn't actually use the technology.
When you say you couldn't use it, you mean it was so overloaded with transactions?
Yes, everything was so overloaded. It was kind of grinding to a halt. Mm-hmm. And on top of that, you had extreme optimism, which is just as good a signal as extreme pessimism. And so around May, I started getting quite cautious.
There's bullish, there's bearish, and there's squeamish. You were squeamish.
Yeah, I was squeamish. I wasn't feeling too good about price action. And
Yeah.
so, and I also noticed there was a lot of leverage. This ties into the FTX story. Unlike the prior bull markets, this bull market, the last bull market, was filled with leverage and credit. And these things lend themselves to crashes when they go wrong. Bull market was not over, so it was waiting for a signal to get back in. Late July, early August, we get the signal, we get back in.
Good.
So we get back in, and now we have one final leg up. Bitcoin bottoms at 30,000 late July 21. It goes all the way up to 70,000 in November.
I'm wondering what the next big round number is going to be, but we'll save that for later.
That's correct. That's correct. And so now I'm going to draw another line because I want to be clear about what happened as I call the top. So to me, the catalyst for calling the top was the Fed. The Fed was going to hike. I was writing about it in 2021 saying, I think the Fed is going to hike and that's going to kill the bull. And so what happened is the Fed announces they're going to hike in November, market tumbles immediately.
Okay, because we were of the theory prior to this that if we followed prior market cycles, there would be a final hyperbolic blow up,
Correct.
right?
That was our base case. However, we had this line.
That orange line you just drew, right?
Mm-hmm.
It doesn't give a damn about theories. It doesn't give a damn about what you might think is going to happen, hyperbolic or not. It just says this is it or not.
Correct. And it said, sadly, in early December, I remember this day specifically because this is actually a big down move. That was the end. Early December, the model says, bull market over.
Okay, so does that mean your model immediately kicks out a sell signal? And does that mean you act on that sell signal?
Yeah, we had no trades on at this time.
Throughout this period, other crypto analysts who are, perma-bulls, they're continually looking for the big bottom, and they say, oh, now this is the bottom. No, this is the bottom, and this is the bottom. And every time they take it on the chin. And so that's where people start getting more and more discouraged because it's like the boy who cried wolf. They don't believe anybody anymore.
Yeah, it's important to remember there's still plenty of bulls here. Even as Bitcoin was going to 30,000 and below, still plenty of bulls. Prices stabilize after that.
At this point, you don't call a bottom because the bear market is not 1 year old yet. It's only 6 months old.
Correct.
And so you're not even looking for a big bottom yet.
It's not time yet.
Okay, and that doesn't happen until
November.
Okay.
This is January 12th. But everybody's saying, oh, it's the death of crypto. Genesis is going to default. The entire industry is going to go under. But I'm watching the downtrend line.
And it's getting closer.
And that is the first signal. That tells our model that you can rule out any crash. You can rule out any incoming sell-off. The market is stable.
But the actual buy signal you sent out was for Ethereum.
It was for Ethereum.
Can you show us the Ethereum chart?
So Ethereum has a few differences that are very noteworthy. So the first one is, here's what the June low is, the red line.
It never even came close to the June low.
No, it never crossed it. So even though FTX was crashing and collapsing and the industry's going to die and all of that stuff, Ethereum is not even making new lows. It looks much more solid.
I see.
It is one of the themes of the next bull market is that Ethereum will outperform again, but also establish itself as a new crypto benchmark.
Could you explain that for us?
Ethereum went through a big major upgrade in September of 2022.
Right.
It transitioned to proof of stake, even though a lot of people said this would never happen. It did happen. It gave a catalyst in the midst of a bear market. ETH rallied strongly on the back of that news.
That has never been happened before in a bear market. Always.
Not only that, this is very important. This hasn't happened with an altcoin, period. This is the first time that a major altcoin does this.
So maybe we shouldn't use the word altcoin anymore.
I call it the twin benchmarks. I've been calling it that for months. These are crypto's two twin benchmarks. I like that name. You have to look at both. You can no longer just assess the state of crypto by looking at Bitcoin, as used to be the case.
So, big picture, what's obvious to me from this discussion, that even more so than in any other asset class, timing in crypto is absolutely critical, right? Timing is absolutely critical. Investors who get it right can make fortunes. Investors who get it wrong can lose fortunes. So Give us some clues regarding how you go about timing the market and how investors can do something similar.
Right. So the way you do is you count time. So you count the number of days between low and low. And this is what we do.
Between low and low, not between top and top.
Between top and top is not as regular. You can still do it, but the way I've set up the model is from low to low.
Okay.
And so in that, I have identified four main cycles, starting with a 20-day cycle. So again, this is from low to low. So every 20 days, crypto markets make a low. Following that, if you add up four of those 20-day cycles, you have an 80-day cycle. This is what is known in the model as a trading cycle. This is what we trade around.
The 80-day cycle.
The 80-day cycle is what we trade around. We base trends on the 80-day cycle and what have you. It's very important. If you take four of those 80-day cycles, you have one 320-day cycle. So it's a yearly cycle, also very prominent in crypto. It's not like a Swiss clock.
Uh-huh.
You don't just set it to 80 days and then forget it and check back in after 80 days. There's some variance in the duration of each cycle. Then we have the 4-year cycle. I have it down to a science of sorts, but there's a lot more that goes into it than just counting time. Yes, counting time is the main factor, but there are other things. So this is why around big bottoms, I break it down into two signals. The first signal is a heads up. It's time to accumulate. It looks like the big bottom is in, near, or already past. Mm-hmm. And then the second signal, which I think is the most important, and if that's still coming, that is confirmation. That tells us that, yes, the first signal is now confirmed. We are in a new bull market.
What's your forecast for this next cycle it has just begun? First, focus on the similarities, and we can cover the differences at another time.
All right. So similarities is what you would expect. Super high volatility. Crypto assets are known for being super volatile, especially to the upside. Mm-hmm. So I expect that to stay the same. I've seen no signs that that's going to change. The other one that I think is the most important is once the signal is confirmed, the market will not trade below that price ever. That is the most important thing. When I say a new bull market or a new cycle is beginning, what I'm saying is that bottom will never be crossed. I expect this bull run to continue for 3 years. A select group of altcoins at the beginning is going to outperform Bitcoin by orders of magnitude. And then toward the end of the bull market, every altcoin outperforms Bitcoin.
Oh, okay. So in the beginning of the bull market, you have to be careful and select only the ones that have the really best technology, right? Mm-hmm. But once the frenzy begins,
basically it's anything with low market cap, people will buy it because it's crypto. So at the end of the frenzy, and when you enter the frenzy stage, it's anything that's crypto, it has a silly name to it, boom, it goes up more than Bitcoin.
Okay, but at that point, are you going to join the crowd and buy some of that crap, or are you going to stay away from it?
No, we're going to stay away from it. Okay. We're going to buy things that we think can fly high, but are also good, fundamentally speaking.
A few days ago, you and I texted about altcoins, and we were talking about ETH, but then you changed the subject to another altcoin.
Yeah, Polygon.
Why Polygon?
So Polygon is it's not a blue chip recognized name like Ethereum or Bitcoin, but it's also not it's not a shitcoin. Okay?
That's the official name nowadays, isn't it? It's not a curse word anymore, but it's the actual term in the crypto dictionary.
Correct. So my main point is that Polygon is a mid-cap coin with, I think, a remarkable future ahead of it.
Why is that?
So number one is Polygon is not an altcoin competing with Ethereum. It's probably the only one that it builds on Ethereum. All the competition, all the other smart contract platforms, there's many. Mm-hmm. What they're trying to do is steal market share from Ethereum. And they've had some success, but it's very hard to beat a crypto's network effect. Mm-hmm. So once it has an established network, and Ethereum has that, the biggest community in all of crypto, once you've established that, it's very hard to steal that. You can develop better technology, but you're not going to steal that community. Very, very difficult to do. It's symbiotic to Ethereum. So what it does is it is attached to it, and it makes it faster and cheaper. This is what I like. Good for Ethereum, good for Polygon, good for Polygon, good for Ethereum. So I like that. It makes it very unique in the entire crypto space. Another thing that I like about Polygon is that it's a great platform to build NFTs on. And they have actually, over the past year, they partnered with many big names, many big brands to develop NFTs on there. A lot of people think of an NFT as just a JPEG with value in it. That's the joke. Oh, it's just an image with value attached to it and it's overpriced. But what the NFTs I'm talking about here are what I call utility NFTs. So NFTs that people want to buy because they get something out of it. It's not just bragging rights. It could be part of a community that you want to be part of, or it could be discounts, it could be tickets, it could be really anything. That's the NFT potentially. The NFT market is the biggest we've ever seen in crypto.
Tickets to a football game, and so forth, right?
It really can be anything. It's really the sky's the limit.
A colleague here at Weiss, Maria Matic, just sent us the list of companies that Polygon is partnering with. Adobe,
Adidas, MasterCard, Meta, Reddit, Starbucks, the NFL, Walt Disney. So what this means is that Polygon is very close from hitting what we've always been talking about in crypto, which is mainstream adoption. These are mainstream, very well-known brands, all of them building on Polygon.
And this is one of the assets you trade, right?
Yeah. So it has everything I like. It has great technology and it's getting a lot better. We haven't even talked about that. It trades very well, like I just said. It has great prospects for mass adoption, and the team. The team is just amazing. I know some of them personally, and well, we've chatted online, and they just have their eyes on the ball. They really know what they're doing. They understand how to scale crypto. They understand how to do it. They understand what makes it appealing to brands, for example. That's why they're so focused on NFTs. So if you look at their marketing team, their tech team, everything is just top of the line. One of my favorite projects.
Next big question. What are the major crypto assets you've selected to trade?
Okay, so the 7 names that I've selected, and bear in mind this list might change, but so far the list we have is Bitcoin, Chainlink, Cardano, Ethereum, Polygon, Polkadot, and Uniswap. The reason I picked them is because they're all very liquid, they're very easy to trade, they have a very good Weiss rating. This list, if you notice, includes 4 of the biggest winners in the last bull cycle, and then it includes 3 more that I think are going to do very well in the next cycle.
Okay, and to be perfectly clear, the 4 that were among the biggest winners last time around were?
Bitcoin, Ethereum, Cardano, and Chainlink.
And the 3 that you predict will be among the biggest winners this time around are?
We spoke about 1, Polygon, then there's Polkadot, and finally Uniswap.
Okay, now here's the $64,000 question. From the day you called the last big bottom, Bitcoin rose 20-fold, right? Ethereum rose 54-fold. Cardano rose 120 times over. Chainlink was up 234 times, all from that same day that you made that call. So, do you predict that these 4 will again deliver that kind of performance this time around?
No. Why do you look so surprised?
I'm not surprised. I mean, we've talked about this before, but I'm wondering why they won't do as well and what to do about it.
All right, so the reason is pretty simple. These assets were not as liquid back then. So as they get more liquid and grow in size, their moves get smaller. So it didn't take as much capital to move them 200 times back then, but now it's going to take a lot more.
And that's a good thing because you want, as an investor, you don't just want super duper, skyrocketing moves. You also want a little bit more stability because with the skyrocketing moves also comes crashing declines.
We have a name for this in finance, Martin. It's the risk-adjusted return. So the risk-adjusted return is very good for Bitcoin, for Ethereum, for Chainlink, for these established names.
Okay. But if you want to have a crack at the kind of big high rises that we saw in Cardano or Chainlink, then what?
That's where we have some of the newer names in our mix as well. That's why I said, hey, listen, this list is what we have today. We may include other names in the list as the market develops.
How do you take advantage of that?
We have our crypto ratings model that we use to select what we think are the best assets. And then we use the crypto timing model to pick the best timing to trade. The crypto ratings model it covers 3 main areas. One is technology, basically how this thing is built. Then there's adoption, so how is it performing in the real world? Is it being used or not? And number 3 is market performance. How does it trade? So that the traders recognize that it has good technology and good adoption. If all of these 3 factors line up, you pick the asset to trade. And then the crypto timing model is to time the cycles, the 20-day cycle, the 80-day cycle, the 320-day cycle, the 4-year cycle. And we use all of these 4 cycles in combination to pick the best times to buy and sell.
Each of these models, I must say, was a massive undertaking by you, Juan, by our data scientists, our developers, in other words, computer programmers. And I want to thank you, Juan, for leading that effort. But let me ask you this. Which of the 2 models do you think can have a bigger impact on investor results, the ratings model or the timing model?
The timing model.
Okay, so please give us some examples of how that combination, in other words, deploying our timing model and our crypto ratings model might have worked. And please compare 2 hypothetical investors. Hypothetical investor A just buys and holds, all right? So he's not using any timing. He's just buying and holding throughout the whole history of Bitcoin. Hypothetical investor B uses the crypto timing model.
All right. Investor A buys $1,000 worth of Bitcoin when it first starts trading in 2010. This investor turns his $1,000 investment into $544,900,000.
That's a lot of money.
Yeah, it's a lot of money. That's why there's so many Bitcoin millionaires and even some billionaires.
What about investor B?
Investor B is going to use the equivalent of our crypto timing model. He executes medium-term trades when the model gives the signal, and he also invests $1,000 using this method. And instead of turning his $1,000 into $544,900,000, he turns it into $5,033,190,000.
5 billion.
5 billion with a B.
And that's a lot more money.
It's 9.2 times more to be exact.
What about Ethereum?
Okay, so let's talk about Ethereum. Let's look again at investor A. He invests $1,000 when Ethereum starts trading for the first time in 2015. He holds through bull and bear markets. He never trades. He never sells. His $1,000 turns into $1,733,000.
It's a lot of money, but it's still much less than the Bitcoin investor.
And that's because Bitcoin has been around a lot longer than Ethereum. Keep in mind that it's 7 years for Ethereum instead of Bitcoin's 12 years. But the outperformance of the model was way better.
For Ethereum.
Yeah, for Ethereum. So investor B, again, using the equivalent of our crypto timing model to time the big bottoms and the big tops, this time he turns his $1,000 investment into $60,873,000. And that is 35.1 times better than investor A.
Much bigger difference with Ethereum.
Yes. And overall, if you include a basket of all the cryptos that we selected for the study, between both different bull and bear cycles, the average outperformance of our crypto timing model over just buy and hold is about 9-1.
And that's the same crypto assets we just listed, right?
Yeah, the same setup.
In other words, if investor A could make a ton of money just by buying and holding, investor B could make 9 times more than a ton of money with the timing model. Are you implying that's what we can expect going forward?
No, I'm not saying that. Keep in mind that each Bitcoin bull market is less spectacular than the prior bull market. And as we said, the biggest winners will be different. So you cannot accept the same outperformance with the same basket of assets.
Okay, well, I'm glad you said that because I want everyone to understand that nothing in this discussion is a promise of what investors can or will make. It's all about giving investors a sense of why we developed our crypto timing model and why we feel it's so important to do everything humanly possible to identify the big bottom and later identify the big top. Not just to go for profits, but hey, also to avoid losses, right?
Right. And that's what I do with the servers that I run. I use the same data that I showed you here. I use the exact same models, same calculations, and all of the things that we discussed here today. The exact same tools. And this is what we try to do.
Great. Any more charts you want to share on your screen right now?
No, but there's a few more critical points that I'd still like to make.
Okay, good. Let me switch over to my other camera and my microphone.
Sure.
My friends, think about what you could do with what you've learned just now. Even if you apply it entirely on your own, I'm confident you can be a much more successful crypto investor. Or alternatively, you can let Juan and our data scientists who support him do the heavy lifting for you. You can let Juan give you the signals.
I'm going to end it here. I'm not going to get into his higher program, but I am going to use what he's using, what Juan is suggested in using. Because I think you have to know more about trading and how to trade. Right now, I'm just mainly in the holding mindset, but I have to develop a training mindset too. Right now, because of limited income, I think Bitcoin and Ethereum would be a basis for me to work off of and put a little money in each and see what happens over the next 3 years. But also in the 3 years to work on trading skills to get them going. Because all this takes time. It takes skill, it takes tools, it takes technology, it takes experience. There is no other way to do this successfully, to avoid losses and to increase your income and your stability and your skill level. There's just no other way to do it.